Most people will work their entire lives and never escape financial anxiety, while a small minority quietly builds wealth that grows whether they're awake, asleep, or on vacation. And the uncomfortable truth is that this gap has almost nothing to do with intelligence, luck, family money, or insider connections. It comes down to how they think about money, work, incentives, and time. And once that mental shift happens, it changes everything. Because for years I lived what looked like the winning path from the outside, a long legal career with rising income, respected clients, and stability. Yet year after year there was a low-grade frustration I couldn't name until the realization hit me hard. I was working hard inside a system instead of working on the system itself, producing results but not direction, motion but not ownership. And most people never catch this because they confuse being busy with building, activity with progress, and effort with leverage. So let me ask you directly, have you ever looked up after a long workday and wondered why, despite doing everything right, nothing actually feels different? Because the worker mindset is built around selling time, optimizing efficiency, and following instructions, while the owner mindset is built around buying time, designing systems, and choosing direction, and that difference creates completely different outcomes over decades, not months. Workers ask how to do the job better. Owners ask why the job exists at all. Workers optimize hours. Owners optimize leverage. And here's the brutal math most people never run. If you earn 80 an hour and somehow work 2,000 hours a year, that's 160,000 before taxes. But no matter how hard you grind, there are only so many hours your body can give. Whereas owning productive assets removes that ceiling entirely because a business, a rental property, or a diversified portfolio of index funds can keep working when you're not. And that's why selling time always hits a wall, while owning systems does not. And this is exactly where Americans misunderstand investing, because many people invest the way workers think, watching tickers, chasing price movement, worrying about when to buy and sell. When ownership thinking asks a different question entirely, what am I actually buying? How does it make money? And will this still be producing cash flow or earnings 20 years from now inside my 401k or Roth IRA? That's why a boring, diversified index fund held consistently can outperform frantic trading over a lifetime, because compounding rewards patience, not activity. And if you've ever wondered why constant market watchers feel exhausted while long-term investors seem calm, that's the reason. Consider a simple example. Invest a $500 low-cost S&P 500 index fund inside a Roth IRA starting at age 30, earning an average long-term return of 7%. And by age 65, you're looking at roughly $680 in tax-free. But wait 10 years to start and you invest the same monthly amount for 25 years, and you end up with less than half of that. Not because you were lazy, but because time, not brilliance, did most of the work. And this is why owners think in decades while workers think in weeks, and why the big money is rarely in buying or selling, but in waiting. Now here's the part most people miss, because owner thinking isn't just about money, it's about incentives. And there are 10 words that explain more about careers, wealth, and broken systems than almost anything else. Show me the incentive, and I'll show you the outcome. Because people don't behave according to what they say they value. They behave according to what they're rewarded for. And once you see this, you can't unsee it. Whether it's why credit card companies push minimum payments, why Social Security rules shape retirement timing, or why people struggle to save when their environment rewards spending, and owners stop moralizing and start engineering, asking not, why are people lazy, but what incentive makes the right behavior easiest? And this applies directly to your own life, because willpower is unreliable, but systems are not. So instead of trying to be disciplined, owners automate good behavior, automatic 401k contributions, automatic Roth IRA funding, sinking funds for property taxes and HOA fees, and emergency savings that remove decision fatigue, because the goal isn't to be heroic. It's to be consistently not stupid over a long period of time. That idea alone explains why avoiding obvious mistakes, high interest debt, lifestyle inflation, undiversified bets, panic selling, often matters more than finding the next hot investment. And let me ask you another question. What's one financial mistake you already know you should stop making, but haven't engineered your environment to prevent? Because inversion, Asking how things fail instead of how they succeed is one of the most powerful owner tools there is, and when it comes to money, destroying wealth is easy overspending, ignoring taxes, underestimating healthcare costs like Medicare premiums, and treating your credit score like it doesn't matter. While building wealth is mostly about not stepping on landmines repeatedly, reputation works the same way, and this is where reliability quietly compounds. Because talent without reliability destroys trust faster than incompetence, and over decades, trust becomes one of the most valuable assets you can own, whether in business, investing partnerships, or career advancement. And I've seen this play out firsthand with people who weren't the smartest in the room, but were absolutely dependable, and they rose anyway. Because owners think about how today's decisions echo 5, 10, 20 years down the line, not just how they feel this week. This long-term lens also kills the victim mindset, which is one of the most destructive patterns there is, because blaming the economy, inflation, your boss, or the system feels justified but surrenders control, while ownership takes responsibility not as self-blame, but as power, asking, "What can I do next?" even in unfair conditions, and that shift alone separates people who recover from setbacks from those who stagnate, because life will deliver unfair blows. But mindset determines the response. Learning is another dividing line, because workers think education ends when school ends, while owners know learning never ends, especially in a world where tax rules change, retirement policies evolve, and entire industries transform, which is why the most consistently successful people read constantly, build mental frameworks instead of memorizing isolated facts, and pull ideas from psychology, economics, history, and business to make better decisions, rather than forcing reality to fit one narrow model. Now let's ground this with a short case example. Imagine two 45-year-old professionals earning the same income. One keeps all savings in cash and a few speculative stocks because they might pop. The other steadily maxes out a 401k, captures the employer match, uses broad index funds for diversification, plans for taxes in retirement, and accounts for healthcare costs. 10 years later, the difference isn't luck. It's structure, because one built a system that rewarded patience, while the other relied on hope. This long view also applies to career choices, because selling things you wouldn't buy, working for people you don't respect, and surrounding yourself with energy, draining colleagues compounds just as negatively as bad investments, while alignment, doing work you respect, with people you admire, creates resilience that money alone can't buy, and over time, that alignment produces better work, stronger networks, and more opportunities. Patience ties it all together, because most good things, skills, relationships, reputation, wealth, compound slowly, and sitting still with a solid plan often feels harder than constant action, yet envy and comparison push people into unnecessary risk. And owners escape that trap by measuring progress against who they were last year, not against someone else's highlight reel, because once you stop racing others, you can finally focus on building something durable. So here's the shift that matters most. Stop asking what you want and start asking who you need to become to deserve it. Stop working only in your life and start working on it. Because when you think like an owner, you stop chasing and start building systems that compound. And once you see the world this way, going back becomes impossible, because you realize the door was never locked. You were just taught to stand on the wrong side of it. And if this changed how you think even a little, drop the word WNER in the comments so I know you're watching closely. Subscribe if you want more clear, no hype breakdowns of money, retirement, and investing in the U.S. system, and watch the next video where I explain how to structure your 401k, Roth IRA, and taxable accounts for long-term simplicity and peace of mind. Quick disclaimer, this content is for education only, not financial advice. Investing involves risk. Returns are not guaranteed, and tax and retirement rules vary by individual situation, so consider consulting a qualified professional before making decisions. Most people spend their entire lives stuck in the same financial loop, earning, spending, worrying, and repeating, while a small minority quietly builds wealth that continues growing regardless of whether they are working, resting, or living their lives. And the difference is not intelligence, privilege, luck, or secret connections, but a fundamental difference in how they think about money. work incentives, and time, because effort alone is never the deciding factor, direction is, and for many years I lived what looked like success on paper, a long professional career with rising income, respected clients, and stability, yet beneath the surface there was a persistent dissatisfaction that never went away because I was operating efficiently inside a system designed to benefit someone else instead of building or owning the system itself. And once that realization fully landed, it reframed everything I understood about careers, investing, and wealth building. Because most people are taught to think like workers from the moment they enter adulthood. Show up, follow instructions, do your job well, collect a paycheck, and hope consistency turns into security, but that model quietly breaks down over time as inflation erodes purchasing power, taxes consume more income, healthcare costs rise, and retirement becomes uncertain, leaving people confused about why decades of hard work did not translate into freedom. And the reason is simple. Workers sell time while owners build assets. Workers optimize effort while owners optimize leverage. Workers focus on activity while owners focus on outcomes. And this distinction compounds massively over a lifetime because selling time always comes with a biological ceiling that no amount of hustle can break, while owning productive assets has no such limit, since a diversified portfolio, a business system, or a rental property continues producing even when the owner steps away. And this is where the American financial system quietly rewards owner thinking through tools like 401k plans, Roth IRAs, index funds, and long-term tax deferral. Yet most people use these tools with a worker mindset, chasing performance, reacting to headlines, or stopping contributions during downturns, which undermines the very compounding they are designed to deliver. Because real ownership is not about constant action. It is about patience, structure, and alignment with incentives. And when incentives are understood, behavior becomes predictable. Because people and systems respond to what they are rewarded for, not what they claim to value, which is why systems outperform willpower every time. And the individuals who build wealth consistently are not more disciplined by nature. They simply design environments that make good decisions automatic, such as automatic payroll deductions into retirement accounts, diversified index fund allocations that reduce emotional decisions, and clear rules around spending that account for taxes, insurance, property taxes, and HOA fees before lifestyle expansion. And this shift from relying on motivation to relying on systems separates those who struggle from those who steadily advance, because over long periods, avoiding obvious mistakes matters more than chasing exceptional wins. And avoiding high-interest debt, concentrated speculation, lifestyle inflation, and panic selling does more for financial outcomes than finding the perfect stock, which is why owner thinking focuses on being consistently not stupid rather than occasionally brilliant. And this principle applies across careers as well, because reliability compounds just like capital, and reputation becomes an asset that opens doors long before resumes or credentials do. Since trust built over decades can multiply opportunity, while a single lapse can erase years of progress. And this long-term lens also dissolves the victim mindset that quietly destroys potential, because blaming inflation, employers, markets, or policy changes feels justified but removes agency, while ownership restores control by focusing on what can be influenced next, even under imperfect conditions. And this approach does not deny hardship, it simply refuses to be defined by it. Because accepting responsibility is not self-blame, it is leverage. And leverage is the currency of owners, and learning itself becomes a form of leverage when approached correctly. Because education does not end with formal schooling, especially in a world where tax codes change, retirement rules evolve, and entire industries transform. And the people who remain adaptable are those who continuously read, synthesize ideas across disciplines, and build mental frameworks instead of memorizing isolated facts, allowing them to make better decisions in unfamiliar situations, which is critical for long-term investing and career resilience. And a simple case illustrates this difference clearly. Consider two professionals in their mid-40s earning similar incomes. One reacts emotionally to markets, holds excessive cash out of fear, speculates on trends, and delays retirement contributions due to uncertainty, while the other consistently maxes out a 4-to-1 captures the employer match, uses broad index funds for diversification, plans ahead for taxes in retirement, and accounts for healthcare costs, including Medicare premiums. And after 10 years, the gap between them is not explained by luck or timing, but by structure and patience, because compounding rewards consistency, not intensity. And the math supports this reality plainly. Investing $500 per month at a long-term average return of 7% inside a tax-advantaged account over 35 years can grow to hundreds of thousands of dollars, while delaying that same habit by a decade dramatically reduces the outcome despite equal effort later, proving that time is the most valuable input in wealth building, not insight or activity, and this same compounding effect applies to careers, relationships, skills, and habits, because alignment over time produces exponential returns, while misalignment quietly drains energy and motivation, which is why working on something that violates personal values or surrounding oneself with draining influences often leads to burnout regardless of income, whereas alignment creates durability and patience becomes a strategic advantage rather than passive waiting, because owners understand that meaningful results often require years to surface, whether in investing, reputation, or skill development. And resisting envy plays a critical role here, since comparison fuels unnecessary risk and dissatisfaction, while focusing on personal progress fosters clarity and long-term commitment, allowing attention to remain on building rather than reacting. And over decades, this mindset produces a life that feels stable rather than frantic, intentional rather than reactive, because owners build once and let systems compound, while workers restart constantly. And at the core of this philosophy is a simple truth: to get what is desired, one must become deserving of it, because the world ultimately rewards value creation, reliability, patience, and alignment more consistently than shortcuts or speculation. And when this shift happens deeply, it becomes impossible to return to transactional thinking, because the individual stops asking what they want next and starts focusing on who they are becoming, designing a life where financial systems support long-term security rather than constant stress. And this perspective reframes retirement not as an age, but as an outcome of ownership, planning, and disciplined patience within the U.S. financial framework, where Social Security becomes a supplement rather than a lifeline, Medicare is anticipated rather than feared, and investments are structured to survive inflation, taxes, and market cycles. And this content is provided for educational purposes only, not as financial advice. Investing involves risk. Returns are never guaranteed, and tax and retirement rules vary by individual situation, so professional guidance may be appropriate. And if this way of thinking resonates, continue building knowledge deliberately, commit to long-term systems over short-term emotion, subscribe for more clear and grounded discussions on U.S. personal finance, retirement planning, and investing, and watch the next video that breaks down how to structure 401ks, Roth IRAs, and taxable accounts for long-term simplicity and peace of mind.